Hello, welcome. In this course, I want us to look at an introduction to financial controls. I want us to appreciate or get to a point where we understand what financial controls are, what they're there for, what management use them for, and the various types of financial controls at a conceptual level, what kind of functions they cover, the kind of challenges organizations face in establishing and instituting effective financial controls, the features of effective financial controls, and mitigating factors or things that you can put in place that help to cover or that help to promote effective financial controls. It is a course that is vital and important to people in the finance sector and the accounting sector, to every organization, because as an organization, even if you make a lot of money, you need to report it, you need to account for it, you need to collate it, you need to aggregate it, you need to be sure that all the processes that relate to your finances are in order. And those are the controls we're going to be looking at. We're going to define what controls are and what they do for management, and how everybody in the organization can contribute to healthy policies and processes and some of the tasks that are associated with effective financial controls. Now, some of these things, no doubt, would have heard about, especially if you're in the financial control function, accounting function, finance function, or you're aspiring to be, or even just in management or in a management position or in a leadership role. But we'll try and explain what the concepts and why some of these things are in place. So hope you stay with us, and please try and follow some of the exercises and examples we're giving, as they're important to the delivery of the importance of this course. All right, see you in the course. Hello, let's look at the importance of financial controls. Financial controls are essential for effective financial management. They play a critical role in helping management achieve their financial objectives. They achieve much more than financial objectives, but we'll stick to that at the moment. So that's their primary goal. The primary goal of financial controls is to help management achieve their objectives. Now, how do they do that? They do that by facilitating accurate financial reporting, enabling effective decision making, ensuring regulatory compliance, managing cash flow, prevention and identification of fraud and errors in the financial statement. So that's the importance of how important financial controls are, and that is why we need to take note of it. Without proper financial controls, organizations risk financial losses, non-compliance with regulatory requirements, and reputational damage, among other things. Controls are the set of policies. What they are now, what are financial controls, or what are controls generally? Controls are the set of policies, frameworks, processes, procedures, and tasks put in place by management to ensure the achievement of the organization's goals and objectives. So these are a collection of different things, different processes, different frameworks, the policies, the procedures, the tasks that need to go in place, that management puts in place to ensure that the organization achieves its goals and objectives, that the organization is not just running without direction, the organization is running with a clear mandate, a clear way of operating and safeguarding anything they make, safeguarding the revenues that come in, safeguarding the assets of the organization, the cash, making sure it's controlled properly, and so on. Now that's what generally controls are. Financial controls in that light focus on the financial aspects of the business, because you can have controls generally in the business in other areas, for example, in how you interact with customer, in collecting customer data, in managing customer data. All those are controls. Those are areas the controls can be put in place. Now, financial controls relate to and deal specifically with controls that relate to the finances of the organization. See you in the next module. So let's delve deeper in this chapter into what are financial controls. I know we touched on it in the previous chapter, but controls generally are a set of policies and framework and processes, like we said before, and procedures and tasks put in place by management to ensure the achievement of the organization's goals and objectives. So these are measures put in place by management to ensure that things are working correctly. It could be a business plan, could be a budget, could be something of that nature. So it's not necessarily something or a particular process or procedure put in place to limit maybe people stealing from the organization or to limit errors or fraud. Yes, those are part of financial controls because most people see controls basically as that only. But controls are also policy documents, are also vision statements, mission statements. Those are also controls in within the organization because they give an idea of how the organization, the management and people in positions of authority within the organization want to see the organization run. So they are controls in themselves in that it tries to dictate how behavior should be within the organization. It tries to dictate what the goal and the focus of the organization should be, and if there's anyone if the organization is straying away from it, they help bring that back. So in a way, if you think about instead of controls like your controller driving your car, a steering wheel or gear stick or something of the sort, or flying an airplane, and those levers you see them pull, they use them not just to stop the aeroplane or to not just to make sure the airplane does not crash, but also to get the airplane in the air or to keep the car on the road, to make sure the car is going well, obviously to make sure the car doesn't crash. And you have levers on there, you have all sorts of measurement gear and things that show you how the equipment is performing. And that's literally what controls are. Controls are there to ensure that the objective of the management and the people running the organization are being met, that those objectives are front and center and they are being met. And now part of that objective is to ensure that things are done correctly, and another part is make sure that things are safeguarded and are not pilfered or stolen, or things are reported correctly. So those are controls generally. So financial controls are a set of processes, procedures, and systems that an organization implements to ensure that its financial transactions are properly managed, are recorded, and reported. Like we spoke about in the previous section, an organization about the importance of financial controls. An organization that doesn't control its money, they don't know how much they have in the bank, they're not sure how much revenue they're making, they're not sure what their accounts are saying, because they don't have confidence in the financial reporting process. An organization where there's no plan or some kind of budget, a projection of some sort, there are no KPIs or key performance indicators being measured and so on, those organizations are going to struggle to assess and determine whether they are going concern, whether they can continue in business. They're going to not be sustainable after a while because they're not monitoring and tracking, but at the same time, they don't even know if they're fulfilling the objective of management. So effective financial controls are really completely crucial. Can you imagine if you got into a car and you're not sure if the steering, if you turn in a certain direction, it will go in that direction? That's the same thing about having all these measures, all these procedures, all these frameworks and policies in place within an organization. You need to be able to steer the organization in the direction you want it to go, especially around its finances and financial reporting and financial management as a whole. So effective financial controls are crucial for the financial health and stability of any organization. Financial controls help to ensure that an organization's financial statements, that's one element of it, as well as all aspects of financial processes, transactions are accurate and reliable, which is important for staff, investors, creditors, and all stakeholders to know. It's important for the sustainability and the continuation of that organization. See you in the next chapter. Hello. I know we mentioned some of the objectives of financial controls in passing as we've introduced what they are. And again, if you you want to really understand what they are. They are a specific set of measures, framework, processes, policies put in place by a business or an organization to ensure that its financial affairs, its financial management, its financial reporting, its financial accounting, and its financial side of the business are properly controlled and taken care of, to ensure that the things are moving in the direction the those responsible for the organization want it to move in. So they encompass so many things. And I want to talk about some of the areas in which the objectives of management, how they actually flow into the business. And I want us to understand what the objectives of these controls are. So they're not just there, and like I said in the previous section, they're not just there to try and catch people out and so on. They do that as well, but that's not their primary goal. The primary goal is to try and achieve the goals, the objective, or the primary aim of these things, to achieve the goals and objectives of the organization. So the objectives of financial controls are to ensure the accuracy, completeness, and reliability of financial information. They are there to ensure management objectives are met and prevent fraud and prevent errors. They're also there to facilitate regulatory compliance and enable effective decision making. So when you look at the financial statements of an organization, and if it's not complete, or if it's something you have a doubt over, or there's no confidence in that, or in that particular financial statement, because you're not sure how it was prepared, you're not sure there were enough controls around the organization to give you reliable and accurate information, you will doubt that. So that's why these things are in place. Now let's take a closer look at each objective. So accuracy is one of the objectives of putting financial controls in place, and we'll look deeper into some of them in the next segment or subsequent segments. The accuracy of the information is important. So controls are put in place to ensure that information that we're all looking at, the information that management is reviewing, those things are accurate. The processes go and the outputs of those processes are accurate. Reliability is another one. Reliability is about trust. It's about people being able to trust what you're producing, trust what is going on. If you cannot rely, for instance, on a bank statement that's coming from your organization's bank account, because you're not quite sure it has captured everything, and there's no process like a bank reconciliation process in place, you can't rely on the number you see to say at the end of a certain period we had X amount of cash or X amount of finances in the bank, and it's not reliable. Therefore, planning becomes difficult. Therefore, the opportunity to take advantage of things that are happening in your industry becomes difficult. You might not even be able to pay salaries, might not even be able to meet your obligations and commitment. Fraud prevention. So obviously, if where you're on top of the numbers, you have the right controls in place, you can pick up where things go wrong very quickly, or where things might go wrong quickly. You can do quick analysis of the business, of the organization, and identify areas where there are gaps where people can come in to actually have some activity that is against the interest of the business. Decision making. I've touched on it as I've gone on, but imagine an organization without a budget, without projections, without any form of plan as to what they want to achieve during the year. How do they know if they're doing well or not? How do they know if a particular product is doing well? How do they know if they need to commit more money or more resources to a particular segment or department or product in the organization? So they look at management accounts, they look at other reporting that is coming through, but they can only do that if they have confidence in the processes that are producing that, confidence in the policies and the tasks that produce those reports. Completeness is a very important one, because you need to understand, you need to appreciate that all the transactions that are related to that organization have been included in the information that is being reviewed. Again, I can go back to the bank statement or bank balance in a bank in a particular organization, and you see that if you don't have confidence, if you don't think all the transactions have been captured and they're incomplete, maybe some checks have not been presented, or some charges from the bank have not been reported on the general ledger, then you don't have full confidence in that, which a bank reconciliation provides as part of reviews that happen on a periodic basis. Regulatory compliance, where you're not certain that every regulatory requirement has been made. Companies' returns or tax returns or other specific industry related returns or reporting has been done and done correctly with the right information, and you have processes for feeding those things, then you don't have the kind of confidence you require, and you might fall foul of regulatory commitments and be infringe on regulatory compliance related aspects. And error prevention, part of one of the areas where you find a lot of things happening, given that we're all human beings and even the systems we use, sometimes there are errors in what we do. There are errors in the way we carry out tasks. There are errors that could just be typographical errors or keying the wrong number in for whatever reasons. And financial controls help reduce the impact of that, reduce that by, for instance, their reviews. Sometimes there are certain returns you can't present until someone else has reviewed it on your behalf, and they can then, or alongside you, and then they can cast an eye on it and to check to see if it's accurate, if it's complete, if there are errors in it, and ask questions and ask for explanations and so on. So these are some of the objectives of management to ensure that the financials of the organization have proper controls around them that give them confidence in their numbers. Welcome. I want us to have a quick look at features of effective financial controls. I know we've defined what financial controls are. We've tried to understand why it's important and the objectives of financial controls, thrown in a few examples so we can appreciate what it is. Try to use an analogy to say financial controls, how important they are to a business in general, and controls in general, how important they are to a business. And I want us to look at features of an effective financial set of controls. Number one is segregation of duties. One of the last things I said in the previous segment was about not making a return, for example, before somebody else had looked at it. Now, in this case, it's sort of similar to that. It's where roles are defined differently. This involves separating responsibilities for financial transactions between different individuals or departments. For example, the person who authorizes a payment should be different from the person who records the payment. So that example is simple. If you are an authorizer on a particular transaction, usually you shouldn't be the same person recording that transaction within the ledger or in the financial books of the organization, and definitely not the person actually taking delivery of that particular order or whatever the payment is being made for, because segregation of duties facilitates people asking questions and saying, I've seen that you've authorized a particular payment, what does that payment relate to? And if that's described, are there invoices or receipts or things that you can present relating to that particular type of transaction? So then it is recorded. Once the other person sees it, verifies, and they're happy with it. This normally happens organically within big organizations, but in small organizations, or if you're just coming into the process, you might need to appreciate that. The example is where you want to go on a travel trip, and you work for an organization. Usually you send it to someone more senior than you to approve it, to say they know about this trip, and then to approve the budget, to say we're happy with this budget. Usually they would have looked within their budget to see if there's room for that, and therefore they can approve it. And then when you get back from the trip, they'll ask you to submit all your receipts and all the things that are invoices and the spend you've made. That you can submit it to another department where someone else has another look at it. And that is a very good example of segregation of duties. Authorization and approval process. So I've just given that example now. This involves setting up formal procedures for approving and reviewing financial transactions such as invoices, expenses, and payroll. So like the example I just gave now, you have to escalate your particular request to someone more senior and to authorize it. And then they look in the budget and say, okay, yes, we have a provision for this expense to be made. And then when the trip is made and you return from it, you submit it to another team or unit that then approves your to say everything you spent and what they've seen is within the company's policy, is within the spend limits, and it meets all their requirements, and they approve it. And then sometimes you get a refund because some organizations ask you to spend your own funds initially, and then bring all the evidence of all the things you spent and submit it to the organization's another department that then approves it and sends your refund directly to you. Another feature of an effective financial control or effective financial controls, budgeting and forecasting. I've touched on it severally. Where budgeting and forecasting plays a key part is in the preparation, is when it's being prepared. Usually, this involves setting up a budgeting process to ensure that the organization is meeting its financial goals and objectives. It's usually tailored towards the goals and objectives of an organization. I usually relies on maybe a previous period or maybe additional resources or what the management and the drivers of the organization are trying to achieve, and they put together what they call a budget or some forecasting tool. The budget is a forecasting tool, usually maybe on a spreadsheet or a particular bespoke software where people make contributions in terms of what they need to spend in a particular period, maybe for the next 3 months, 6 months, or 1 year, to be able to achieve the targets or the objectives of the organization. Remember, I said the key function of controls is to help management achieve its objectives. But the management recognizes that to achieve that, they might need to spend some money, they might need to make some commitments and provide resources. So budgeting helps you do that. You do it before the events happen, before the spend happen, before things are purchased or things are sold, however that goes. But you do it and then you measure what is happening in reality with those projections and try to explain the difference and try to say, this is why we haven't met our objectives, or this is why we've exceeded our objectives, or this is why we are on track to meet our objectives. So budgets and forecasts are very important tools used in an effective financial controls environment. See you in the next segment. Welcome. Other features of an effective financial controls environment in an organization or in your business or your business function, include internal audit. Now, this involves conducting periodic internal audits to identify any weaknesses in financial controls and to ensure compliance with accounting, other standards, and regulations. An internal audit is just a review of the organization's processes, especially with the aim to identify if there are any gaps, if objectives are being met, how is the organization faring, but from an internal perspective. Now, it can be outsourced. I've seen where it's outsourced. Several businesses outsource this function to a third party, maybe an accounting firm. They come in, they have a look at the processes, have a look at the numbers. Then they carry out reviews of things like the budgets and forecasts. They carry out reviews of things like how do you carry out bank reconciliations. They carry out reviews around inventories, they're being accounted for properly, and you having regular stock takes. They carry out reviews around how numbers are being recorded into the financial statement, how the technology is working, your financial statement reporting to how all of that is working. They assess it and they prepare a report back to management to say, we've done this review and this is what we found for Q1, Q2, or for the whole year of whatever year it is, and we found that these are the gaps, or these are the processes that can be improved. Here are maybe these are the reasons why certain targets were not met, or certain budgetary items were overspent on, and so on. So that is what an internal audit does. Internal because it's a good practice, it's best practice, but usually these reports are only submitted internally to the organization, to the management, to the board, and so on, not necessarily submitted to third parties or to maybe stock exchange, for instance. Though most organizations that are listed on stock exchange that have shareholders that are so many actually tell their shareholders that we have been carrying out internal audit exercises during the year to give them comfort and confidence in what they're looking at in the financial statement, as well as the external audit. But we're not looking at external audit in this particular segment. So asset management. Asset management is another good feature of an effective financial control framework or effective financial control environment. This involves implementing processes to manage and safeguard assets such as cash, inventory, fixed assets, and so on. So the example is you have a fleet of vehicles that are running in your organization. Those vehicles are recorded in the financial statements as a particular carrying value. Now, those same values have um, have policies around them. There are depreciation policies. There are expenses that are allowed, and there are tax related implications, there are insurance and other things that are related to that. Now, that's where the financial side comes in. I know some might be wondering why you're talking about vehicles and financial control. So they are assets of the business to help deliver the management's objectives, whether they're for delivery, for pickups, for all sorts of things. Now, those assets need to be properly monitored. They need to be tracked. They need to know where they are, and they need to be maintained to ensure that the assets are being managed correctly by the organization. They're not being stolen, or they're not being used for wrong purposes, or they're not being mismanaged. Or there are many ways of looking at that or doing that. They can look at expenses being spent on on these vehicles over a period of time as compared to the period before, looking at the age of the vehicles, looking at how many repairs are being made of these vehicles, and that's a good way of having good financial controls or effective financial controls around things like assets that are like motor vehicles, for instance. Next, record keeping and reporting. This involves establishing and maintaining accurate, timely financial records, including the general ledger, the inventory register and inventory generally, management accounts, financial statements, tax filings, and other regulatory requirements. So, having said all this, and I know we've touched on this um, over the period we've been speaking in previous segments, and now the record keeping and reporting needs to be paid attention to. I'll give you an example of inventory. When the process usually for ordering inventory is there is a need, we have objectives, we're manufacturing something or we're delivering something or we're working with a particular organization to actually carry out a service and we need to order things in. Then usually a business would issue a tender and they probably bid, there's a bid process and they eventually get suppliers come in and supply, then they are given an order, a purchase order. When that purchase order is recorded in the books, is recorded in the financials, and said we have asked company XYZ to supply ABC to us. When the company comes to supply it, and those things are being kept in inventory, we have to make sure that there's segregation of duties, there's asset management that are kept correctly and stored properly to maintain the value of those assets to ensure that they're there to serve the organization. Now, when those goods are taken in, someone needs to attest to the fact or sign for them or say we have recognized that goods ABC were supplied to us. When someone within the organization attests to that, they then issue some confirmation to say we've seen these goods, we received them, and these were the goods we received where possible with some form of inspection. Then the company that supplies it usually will send their paperwork to the company that placed the order to say we supplied you XYZ, could you please pay us now? And then that payment is processed. They confirm what has been supplied or verify what has been supplied from their paperwork, what was supplied in the inventory in the store department or in the storage department. They compare the two things usually, and then they send it off to get it processed by the accounts payable or department that deals with processing payments to suppliers and they will carry out some kind of checks, so some their checks as well. They check if the supplier is recognized, if it's the person. They check the purchase order to make sure that that was correctly executed. They check what was received in the inventory. They will check what paperwork was sent in, and then they begin to process the payment. Usually there are terms and conditions within the purchase order that tells you how many days or how long and so on, and what kind of condition the goods should be in. And the payment department, accounts payable department will check all of that before payments are made, or procurement department before payments are made. So overall, financial controls are an essential component of an organization's financial statement. Effective financial controls can help an organization to minimize the risk of financial loss due to fraud errors and other types of financial mismanagement. They also help to ensure that an organization's financial statements are accurate and reliable, which is important for investors, creditors, and all other stakeholders, which is important for the sustainability and continuation of that particular organization. I know we've gone through a lot. I would like you to repeat this module or this particular segment if you want, because there are a lot of examples that we've packed in here. I'm trying to explain the purchase process, purchase order process, tendering process, and so on. And I know we're limited for time sometimes, so please feel free to replay this and rewind it and try and understand what we've spoken about here. But the takeaway is internal controls, asset management, record keeping, and reporting are very effective features of a good financial, of an effective, are very good features of an effective financial controls framework in any organization. See you in the next segment. Hello. I want us to look at financial control policies. So we've spoken about financial controls, what the objectives are for a business or should be. We've touched on a few areas, talked about features of an effective financial controls framework or environment in an organization. But usually many of these things start from the policy segment. They start from the height of policy, which management puts in place around certain aspects of the business. So financial control policies are a set of guidelines and procedures that an organization puts in place to manage its financial resources and ensure accountability, transparency, and compliance with legal and regulatory requirements. These policies usually span across various functions, various processes, and help determine the performance of an organization. So they can collect financial information, collect data, collect information that is required for decision making, collect information that is required for ultimate processing and use by the organization, and give a flavor, give an understanding on the performance of the business and how and where areas in which management should focus on improving, directing resources, maybe providing additional cover, providing additional protection for assets, and so on and so on. Here are some of the key areas where financial controls policies are common in an organization. So they're not limited to this, but you usually see them in these areas, and they're usually across various functions. It's not just in finance. The tendency is to think because it's called financial controls, you only see it in finance. So across sales, the whole sales process, and we'll look a bit deeper into them in the next segment. You find a lot of financial control policies and processes. Revenues, how do you generate your revenues when you've made sales? How do you book it? How do you recognize it? And so on. Human resources and payroll. So who is issuing the offer letter, who is making the payments and salary, the people they're paying salaries to exist, and so on. Are they paying the right amount, the right taxes, and all those other payroll related items? Inventory. We used an example in the previous segment about inventory and taking in inventory into an organization where they purchase goods, and we spoke about many segments of that whole process or that chain. Finance, accounting, and tax. That's an area where the reporting needs to be right, the payments and compliance with the tax authorities and other stakeholders needs to be correct. Legal, the financial controls around legal as well. Are we paying fines, and why are we paying fines? Are we Are we infringing on other people's rights or other things or copyright and so on? Do we have our intellectual property well protected and other examples as such? Cash and bank. Cash and bank, we've used bank and bank reconciliations as examples severally in this particular, in this course so far, and will continue to do so because it's a vital element. So cash and bank is a good area of the business where financial controls exist and need to be continually reviewed. Fixed assets, or assets that are used within the business in general, the building, the plant, the machinery, the equipment that are used and utilized to produce, that are used actually for economic activity, have significant financial controls around them, right from the policies segment, depreciation policy, write-off policies, and other policies that we need to look at. And we'll touch on a few of these, all of this in the next segment. Revenue, we talk about sales, and what about revenues? How we recognizing that, how we reporting that, how we capturing that, we making sure things are banked in the bank account after the sales have been made. Around information technology, a policy around information technology that determines who can access certain information, who can make changes within the information technology system, who can print reports, what kind of reports can be designed and bespoke, and so on, and many other policies. So organizations have policies that give us an inclination, a direction as to what kinds of activities should happen within the organization, usually quite detailed around some of these functions. These are there, again, remember, to try to ensure that management objectives are met, monitored, and if there are any issues, corrected. See you in the next segment. Hi, welcome. We looked at financial control policies, just a general overview, and some aspects where they're important. I want us to look at specific examples in terms of policies that could be instituted or areas that we mentioned before, and we'll just go through them very quickly to give you a flavor of the kind of policies that could be in place. So sales, a separation of actual sales team from the payment. Recording, from also separation from the recording, but also getting reports on sales. So in the sales segment we looked at earlier on as a policy, usually businesses have a policy on sales, on how sales are recorded, how they're recognized, and how payments go out. So it's not the same person making the deal, the transactions, to say, hey, we want to sell you this product, that is also in charge of making the payment or transferring the money to the person that we're selling the product to. So there's a separation and segregation of duty in that regard, which gives it some measure of control. But also in the recording, because now you have two different points of interaction on a sale, how they're recorded needs to be coordinated, and they need to be reconciled, and reporting around that also needs to be looked at. So those are controls. That's why they're separated, and then they're reconciled. The reconciliation is to check to verify one against the other. Human resources and payroll. Employment letters, for instance, whoever generates it, or who's the people doing the interviews, are not usually too involved in creating the employment letter because of the financial and legal implications, obviously. So employment letters will be signed by somebody else who will review it to make sure they understand what's in it and the commitment they're making or they're putting the organization into. And setting up payroll payments, and then those people paying salaries are then separated, or separate set of people from those who work directly with the people, and those who actually do the employment and the payroll are usually separate in the human resources section. And then every month, or every payroll expense that needs to go out is authorized by someone else, is reviewed by someone else, and instructions going to the bank to make certain payments are also reviewed, and usually goes to another department to be reviewed. So all of the human resource expenditure, I used the travel expenditure, for instance, earlier on. If those are reviewed, for instance, if a particular member of staff is not entitled to actually going on trips, and they go on trips and they want to make a return, then those kinds of things are brought up and examined and looked at, and those are sort of controls that are in place. Inventory is a good one. Inventory inventory relates to security and who is in charge of security of the organization's assets. How are we securing them to make sure they're properly maintained, they're properly taken care of, they're probably properly looked after. The purchase process, I discussed the purchase process in the previous segment. Please refer to that so I don't take too much of our time. The manufacturing process, dispatch and management of inventory usually are separate people and their reports are compared to one another. Finance, accounting and tax, recording, reconciliations, audit, compliance, accounts, returns, general ledger controls, transaction approvals, payment controls, accounting standards, compliance, and so on are looked at by different people, and these are actually raised with the relevant people in a department, in a team, to point out where there are gaps or to ensure that the objectives that are set out are being met. And these are done regularly. These are done periodically. We looked at internal audit in another as a feature of an effective financial control framework or environment. That is also part of finance, accounting, and tax, and making sure that the general ledger controls. For instance, general ledger controls could be that one person cannot create business entities within the general ledger. They need approval from someone else who asks, why do you need this business entity? What will be in it? What will be going through it? And then they get several approvals from different people so they don't start reporting things that are not authorized within that particular business entity or general ledger entity. Procurement, suppliers, bids, recording, delivery, monitoring, payment, and terms. We discussed that in a previous segment where we looked at inventory. We merged those two together, but the suppliers, who the suppliers are, and the bids that are made for tenders, recording the delivery, looking at it through the inventory, and monitoring the payments going on, the terms, are all separate people, and there are reconciliations and comparisons done between all the reporting of the various segments of the various departments. Cash and bank, separation of duties in the cash and bank process, including booking the cash transactions, whether they are payments or receipts, and liaising with the bank, like we spoke about payroll earlier on, getting an authorizer to approve payroll payments. That's also part of dealing with the bank, because then sometimes money leaves the bank and those need approvals, and people need to be separate in dealing with that. Reconciliations, cash deposits, approvals, and so on. Some businesses don't take cash deposits because these are easy to manipulate or open to theft. And reconciliations, we've discussed a couple of times, where you compare the bank accounts to what you have on your ledger, to find out what items are not in one but in the other, and try and explain what that difference is. That's literally what a bank reconciliation is, and that is done periodically, maybe on a monthly basis, a quarterly basis, or even weekly or daily. Some businesses do it daily. Fixed assets, for instance, acquisition, procurement, recording, storage, maintenance, and replacement of fixed assets is very key. It's very similar to the inventory in some ways, and procurement, supply processes we mentioned, but the companies really have policies that are specific to these things. They talk about depreciation, talks about maintenance, talks about when an asset can be brought into use, work in progress, and how it's reported on the balance sheet, how it's reported on the financial statements, and many more. Revenues. How are revenues recorded? How are there reconciliations between sales, revenue, inventory, and procurement? They're all related items, and some businesses carry out regular reconciliations on these, accounting for and reporting of revenues. Information technology, selection of the right system. So you want to implement a reporting system, or you want to implement a software, an IT software, or general ledger system. How do you select it properly? Who's the supplier? Have you checked their background? What they have, does it meet the requirement of the organization? All of these are financial, because then you can incorporate a lot of financial control related measures into the software if it meets your requirement. Implementation, replacement, award of contracts, and upgrades. So these are examples within an organization. There are many, many more, but these are examples of policies that companies put in place to ensure things run well on the financial control side of things. See you in the next segment. Welcome back. So, in summary, financial control policies guide every aspect of financial controls l- lower down the chain. It sets the precedent, it sets the environment for everything else to happen. It sets the environment for processes to be layered on. It sets the environment for different procedures and tasks to take place because the organization tells us that these are the policies we live by. These are statements that guide the way we do things around each function, around each organization, around each delivery that we expect from the organization, from various teams, various functions within the organization. So these processes and functions will follow certain principles, and some of these principles we've gone over them again and again, but repetition helps in this particular situation. Segregation of duties, approval processes, budgeting and forecasting, record keeping and reporting, internal auditing, asset management, and risk management. Everything we're doing, there'll be policies for these things. There'll be policies for how functions should operate to ensure that some of these things are incorporated alongside effective financial control features that will be inserted into all the functions across the organization, across sales, revenue, inventory. We've spoken about them severally. Now, in summary, financial control policies are critical for organizations of all sizes and types to maintain trust of stakeholders, to comply with regulations, and achieve their financial objectives. By establishing clear guidelines and procedures for financial reporting, for monitoring, and decision making, organizations can minimize the risk of financial fraud, minimize errors and mismanagement, and also ensure that they are using their financial resources to the most effective in the most effective and efficient way. Those are the reasons, objectives. Remember at the beginning we spoke about reasons or objectives of an organization implementing effective financial control procedures or effective financial control framework environment, and it's to ensure that resources are being managed properly to achieve the goals and objectives of that particular organization. So these please go back to some of these things like we said and review them if you need to, and please try and take part in some of the exercises and measures, things we put in to help reiterate the knowledge. All right, see you in the next segment. Welcome back. Financial control processes and procedures. So we spoke about policy in the previous segment, and we touched on a few policy areas where financial control policies are made, and it guides the operation of the business. Now I want us to look at processes and procedures. Now processes are a collection of tasks, so which derive from the policies. These are like a series of tasks that need to happen or that happen that derive from a policy, from the policies and the systems that an organization wants to implement. Financial control processes and procedures are a collective set of tasks put in place to ensure financial resources are utilized and managed, recorded, and understood effectively and efficiently. This is to aid management in the delivery of set objectives. These processes and procedures are conducted in compliance with legal and regulatory requirements and promote transparency, accountability, accuracy in financial reporting. Here are some of the key examples of financial control processes and procedures. So these are just examples that you find in an organization. Budgeting and forecasting. This involves developing a comprehensive plan outlining the organization's expected or projected financial economic activity over a specified period, for example, a year or 6 months and so on. This procedure helps the organization focus on the plan and refer to it often, and it also helps the organization monitor its financial activities. It helps to prioritize relevant activities to which have been planned from the beginning of the year or whatever period this budget or forecast covers. It helps prioritize relevant activities to achieve its objectives, and it also helps manage expenses, control cash flow, and avoid overspending. I gave an example in previous segment about people we go on a trip or travel on behalf of the business and you return. Usually there's a policy that relates to that. But then when you return, you then need to follow a process to be able to get a refund from some of the expenses made. So one of the things that people look at is to, before the trip is even approved, they check to see if there's a budget for that, if there's provision for that trip to happen in that particular period, and to avoid overspend and to avoid to manage cash and resources better. That's just a small example. There are bigger examples in terms of acquisition of material, acquisition of services, and procuring huge assets or inventory and things of that nature. Authorization procedure is another good process. That process involves establishing clear practices and procedures for authorizing financial transactions, including spending limits and approval processes. We've spoken about approval processes in this particular previously in various segments. This procedure ensures that financial decisions are made in accordance with the organization's goals and objectives. Budgets and forecasts are taken into consideration as part of this process. All commitments or expenditure are reviewed against budgets and the right level of authorization. So within organizations, usually have a strata, a ladder of who can approve up to what amount. Now, this is saying that there's an authorization process or procedure where you need to actually go to someone who can approve the right amount required for that particular expenditure or commitment. And in doing that, it's the beginning of a process, because the person then checks again against budget, checks if this thing is valid, checks the quota, makes necessary checks to make sure it's in line with the management's objectives before they approve it, because they append their name to it or their signatures to it, and they are now responsible, or they have a certain level of responsibility attached to that particular expense. Now, you could have a director that's probably allowed to sign off a certain amount that's much bigger than, obviously, a manager who's much bigger than. Usually people below management level don't really get the authorization, but in some businesses they do give them authorization to make a certain spends if it's within a certain bracket. See you in the next segment. Welcome back. Financial control processes and procedures basically speak about record keeping and documentation, or one of the features that we're going to look at as it relates to processes. And this involves developing procedures for recording and documenting all financial transactions, including invoices, receipts, and bank statements, among many others. There's so many financial transactions that go on in a business that need to be kept and recorded, that need to be documented alongside some of the other processes that take place. This procedure ensures that financial records are accurate and they are complete and are easily accessible by relevant authorized people only. You don't want people that shouldn't have access to certain documents on the IT system or the technology system, the general ledger system, going in there to actually have a look around or change figures and things of that nature. So record keeping and documentation is vital. And before you make any expense, it has to be checked. You have to see evidence that that expense is valid and it's within the plan and plans and goals and objectives of the organization. Another process that is very vital, related to this one in some ways, is producing reports. Reports that relate to finance, that relate to management, that relate to tax, that relate to risks, that relate to other things within the business. These reports are used to monitor. These reports are used to understand what's going on in the business and reviewed on a periodic basis. Could be a daily report, weekly report, or could be a monthly report, quarterly report. There are many different types of reports, like management accounts that management use to understand on a periodic basis, usually a monthly basis, what is happening within the business, which is slightly different from a financial statement that is prepared at the end of maybe 6 months or end of the year, and they're usually slightly different. The main use of a management account as a report is for management itself, as it says on the tin, management accounts, to understand what's going on in the business, to see some key performance indicators or KPIs included in them. But the external financial statements or financial accounts of the organization are utilized by a wider group of people, including investors and other stakeholders, regulatory bodies, and so on. This involves monitoring the organization's performance through the production of reports, which enable management to have an understanding of the performance of the business. These reports include those mentioned above, enable effective decision making. Reconciliation procedures. This involves regularly reconciling financial records, for example, bank statements to the bank ledger balances, highlighting, explaining, and understanding transactions in one but not in the other, examining receipts, invoices, and other documentation against purchases, against payments, against inventory, and so on, and other financial documentation reconciliations. This also helps to highlight errors, gaps in financial records, as well as to ensure that all financial transactions are accurately recorded. Bank reconciliations are common. I think we've mentioned them severally in various segments in this course, because they are vital. They tell you how much you can rely on the bank balance you have, or the cash balance or cash position an organization displays. And an organization is nothing without its cash flow being up to speed and reported correctly. See you in the next segment. Welcome. In this segment, I want to look at financial control processes and procedures, continuing to look at some of the examples of processes that are in place or should be in place in an effective financial control environment. Audit processes and procedures. So an audit is effectively a review. It's a review with certain objectives. It's a review that facilitates the ability of someone, either independent or internal, but independent of that function, to cast an eye, to look at what is going on in a particular part of the business, that processes are being followed, that the policies are being adhered to, and that there are no gaps that can be exploited or that can create problems or create unintended consequences for the organization. Audit processes and procedures involve establishing procedures for internal and external audits to assess the effectiveness of the organization's health, the organization's financial statement, the processes that feed into that, and procedures. An audit process also helps to identify areas for improvement. Usually an audit is accompanied by an improvement report, a report that identifies gaps that were seen during the exercise and how management can improve them. Improve on blocking and plugging those gaps. So audits identify improvements, and usually audits are done by sample testing. Audits are not 100% test or verification of transactions, financial transactions coming through a business. They are done through sample testing, i.e. the select a few samples from certain segments of the transactions that have gone through, financial transactions that have gone through the business, and test them. For instance, they trace the whole process. Was it, for instance, was this particular transaction properly authorized? Did it pass through the right channels? How long were the terms followed? If it was a purchase order or some other kind of order, how long did it take for the money to come into the bank or leave the bank account, and has that been reconciled, and so on. This is illegal, and it also helps check the validity of transactions that are being reported. This is a legal and regulatory requirement for organizations of a certain size, and a healthy practice for all businesses to do. Like I said, it's a review process that gives you a report at the end of the day and helps improve your business. Risk management is another set of processes and procedures that organizations deploy. Risk management entails developing procedures to assess and manage financial risks, such as credit checks or credit risks that might occur, and instituting a credit check on customers before you give them goods and services on credit, for example. Market risks, examining what might be a problem, maybe in another country, in a particular industry, or maybe a pending issue before you sell into that industry in case those risks crystallize, or even operational risks, things that might occur that might prevent the operations of the business from continuing and being able to serve or deliver the requirements that and commitments that be made to other people. And all this could affect the organization's health, the organization's viability, and reputation. This procedure helps to minimize the impact of potential financial losses or disruption. In summary, financial control procedures are critical for any organization to manage their financial resources and effectively. So you put in place clear collection of tasks that facilitate and enable you to assess the health of your business, or to protect your business from things going wrong, but at the same time incorporating areas of improvement, incorporating ways of reviewing and identifying gaps, areas of ensuring that the business is sustainable, and what you're reporting, what you're putting in your reports, whether they are internal reports or reports utilized by external parties, are accurate, they're timely, they're correct, they are complete, and they represent the true state, the true health, the true position of your organization. See you in the next segment. Welcome back. I want us to look at financial control tasks. So financial control tasks refer to the actual doing of the work relating to financial controls. Remember, we said policies are the framework. This set the tone. They're the terms. They provide the environment. They create the environment in which and terms in which the business would carry out financial control procedures or financial control set of things or activities and events and system that they would implement. Now, the processes and procedures are a collection of tasks that help actuate, that help realize the policies that have been put in place. Now, these tasks, what we want to look at in this segment are the actual tasks and some areas and the kind of tasks that can be put in place, actual doing of the work. Some of the examples include some things we've discussed, but we'll look at some examples as to tasks that might fall under financial control related tasks. Budgeting. Developing a detailed plan for how financial resources will be allocated and managed is a task, and monitoring actual performance against the budget is also a task. So preparing the budget, preparing the forecast, and then monitoring it on a periodic basis is a task. Looking at what the differences are, what the variances are, and looking for explanation within the period, within the transactions carried out by the organization. This is actually done across departments, across functions, and prepared periodically, incorporating measurement of performance against the previous periods, e.g. quarterly, annually, and also explaining it. So this is the task now at the cold face. This is where the work is really being done to carry out a set of tasks that form processes, then come together that form a system that are directed by policies. Accounting. These are also tasks that involve recording and managing financial transactions, including income, expense, balance sheet, cash flow statements, and many others. In the general ledger that eventually these things feed into the financial statements or management accounts, or whether they're being used for tax and other regulatory reporting. When an asset is purchased or bought, it has to be delivered. Then it has to be inspected. It has to be signed off as the right asset. Was the right asset ordered? Was the right quantity ordered? The right quality ordered? Then payment needs to happen, and then you go through the payment procedures, and these are initiated. It also has to be recorded in line with the appropriate accounting policy standard adopted by the organization. So this is saying that, and that's just an example where an asset is purchased and it has to be delivered, and once it's delivered, it has to go through many different tasks by several people within the organization to ensure it's captured correctly, it's recorded appropriately, and it's treated right, and it shows up in the financial statements. So these are the differences, if you might want to say that, between tasks and procedures. Is tasks that are the actual doing of the work. Processes and procedures are a collection, like a group of tasks that help fulfill the policy. See you in the next segment. Welcome. I want to look at some other financial control tasks. Financial reporting. Preparing financial statements or monthly management accounts, the actual work, and other reports that provide an overview of an organization's financial performance is an actual task. Usually people draw information from various sources. They prepare a pro forma template and they go into the general ledger. Sometimes, most times, there's a mapping that goes on between what's in the general ledger and how you get into financial statements. And they test to make sure that that is still accurate. And they draw information from different sources, prepare the financial statements or prepare the management accounts or prepare whatever kind of accounts are required or reports that are required, and deliver that to management. Another example of tasks that happen, or a function where there are a lot of tasks involved, is the is internal controls. So internal controls relate to financial controls. Remember, we said controls are a set of systems and processes and events and tasks and measures put in place by management to help them fulfill management objectives. So a vivid example of an internal control is ensuring that people cannot authorize expenditure above their authorization limits, and processes are being followed properly and documented. Other ways of ensuring this is to make sure reviews of key documents, pieces of work subject to multiple reviews. So not one person can't just create a document and push it into the financial statements, or push it or prepare it and deliver it into the company's systems. They need to give it to somebody else to have a look at it. And that is a very good internal control that people can institute within their teams, within their departments, within their function. Another financial control task that is useful in the area of risk management: reviewing the creditworthiness of a debtor, actually going in and preparing, running a report on the creditworthiness of a debtor and recording it somewhere, saving down that report somewhere before releasing products to them, is a good example. That's risk management, because you're safeguarding the company's sales, you're safeguarding the company's sales procedure, and you're ensuring that only worthy organizations that can deal with that company, there'll be a policy around that, and hopefully maybe a suppliers list that is regularly tested. It also includes carrying out tests on products before selling them, just to ensure that they do what they say, to ensure that they perform as promised and will not cause harm or misperform or perform in a way that creates problems for the organization. Another example of risk management is regular reviews of areas known to create financial risks, for example, in cash and bank transactions. Who can open bank accounts, who can authorize it, who reports the bank line in the financial statements, and who gives permission for that, for a new account to be created that relates to the bank or cash related transactions. These are areas where their actual tasks that are being performed along the risk management perspective, but they usually straddle more than one area, because you're talking about segregation of duty, we're talking about authorizations, we're talking about people ensuring that things are done the right way, documentation and recording. So they straddle several aspects and several functions. See you in the next segment. Welcome back. Financial control tasks. Lastly, let's look at audit and compliance. Like I said in the previous segment, audit is really a review that is based on sample testing to make sure that verification, or to verify that everything in the company's financial statements or the company's financial transactions are reflected and represented correctly. And this involves conducting regular audits to ensure that an organization's financial records are accurate, are complete, and in compliance with acceptable laws and regulations. So, like, audits sometimes connotes things that are bigger. It's a form of review, periodic review that is done with the aim of pointing out gaps in the system or within your organization that can be improved upon. I remember in the previous workplace where we'd actually exchange briefly, just for a day or so, the tasks you were carrying out, and you exchange with another member of the team, and they would carry out reviews on it, and they would try and reperform it because we had documented processes, and they try and reperform using your documented processes, and would help note areas of improvement that you could incorporate to help achieve the objective of management. And that went on for a long time, and that a lot of organizations have variations of that. Now, while that is not a formal audit, it's an internal audit. It's not also not an external audit, which are more regulatory required. And internal audits are more serious, structured setup. They form some kind of compliance. They help with compliance in a lot of ways. So overall, financial controls or control tasks in actually doing the work. Like I said, they would actually take over your work for the day or for half a day and try and reperform some of what you do and try and arrive at the same conclusions just to make sure that everything is in order and they can help the organization improve where possible. So financial control tasks are essential for any organization's success. They provide a framework for managing financial resources effectively and applicable and efficiently, mitigating financial risk and ensuring compliance with applicable laws and regulation. By undertaking financial control tasks, organizations can optimize their financial resources and achieve their financial goals. See you in the next segment. Welcome. Let's look at classification of financial controls. So sometimes financial controls are classified along the lines of what they do or what features they have. So I want us to look at a few of those. For example, physical controls in terms of keeping assets and properties safe. So I want us to have a look at those from that perspective. Authorization controls. Authorization controls are designed to ensure the financial transactions are authorized by the appropriate personnel. This control ensures that only authorized personnel are allowed to initiate, approve, and execute financial transactions. For example, a company may have a policy that all purchase orders above a certain amount must be approved by a manager before they are processed. So those are authorization controls. That helps to ensure that someone senior enough knows about that transaction and is approving it to say they know about it and they're happy for that to go on or to be carried out to execute it. Segregation of duties. Segregation of duties involves separating tasks between different individuals to prevent fraud and errors. For example, an employee who handles cash receipts should not also be responsible for recording the transactions. This separation of duties ensure that one person cannot initiate a transaction, approve the same transaction, and execute on the same transaction, reducing the risk of fraud. But beyond that, also improving where you can, improving the process, improving the ability for someone else to have a look at it and be able to guide or provide direction or provide some measure of insight into that particular transaction that helps and supports what is management's objective ultimately. So segregation of duties can be seen in many different aspects of what we do. I know we've touched on it in the segments before, and it is one of the most common things you will find in businesses, in big organizations, where things go to other people for approval or where things need to go to another stage to have it actually reviewed, understood, and pushed through. Again, some of the managers or some people that actually need to look at these things check documents along the way, check against the budget, check that it's been approved, it's been authorized properly by the people in charge, and that those people have the right authorization to do it. So, authorization controls and segregation of duties are two ways or classifications of financial controls. See you in the next segment. Welcome back. So we're looking at in the previous segment, we're looking at the classifications of financial controls, and I want us to have a quick look at another two here. Physical controls. Physical controls are designed to safeguard an organization's assets, such as cash, inventory, and equipment. For example, a company may require all employees to use lockers to store their personal belongings when they come into the office, or whenever they come into the office at the beginning of their work, ensure that only authorized personnel have access to sensitive areas. And in some cases, like maybe in supermarkets or grocery stores, usually sometimes the uniform, or there people are required to wear uniforms that usually do not have pockets and things of that nature, to just to prevent the potential theft or things leaving the shop floor. But sometimes also these physical controls can apply to things like cars, to inventory, larger items or investments, real estate, and so on, and provide security, CCTV, that's a closed circuit television, to ensure things are done. And also part of physical control is insurance and things of that nature, to ensure that the assets that have been procured by the organization are safe or can be mitigated if something goes wrong. Next, let's look at reconciliation controls. Reconciliation controls are used to ensure that financial controls are accurate and complete. For example, a company may require all bank accounts to be reconciled on a monthly basis to ensure that the recorded transactions match the bank statements. We have looked at this in previous segments. And reconciliation controls exist for sales, exist for revenue, exist for payroll, exist for taxes, exist for so many different elements of any organization. See you in the next segment. Welcome back. Audit controls. Audit controls are designed to monitor financial transactions and detect any errors or irregularities. Now again, audit is a review. It's a review of financial statements, of processes, of tasks, of against things like the regulatory requirements, against things like the plan, or objectives, or budgets, or management's vision, or the particular industry standards, industry the organization operates in, and other standards that are required of the organization. For example, a company may conduct periodic audit of its financial records to ensure that they are accurate and complete. Next, IT controls. IT controls are designed to ensure the security and integrity of an organization's financial information. For example, a company may require all users to log in with a unique username and password to access the financial systems, or any system for that matter, ensuring that only authorized personnel have access to sensitive data. And usually sometimes the business or an IT control will be for frequent changes of that password, to ensure it's the same person that is still logging in or having access to areas they should have, and also define the amount of areas or the level of access that people have to certain type of data. For instance, you wouldn't give someone that just joined the company access to information that's available to the top executives, for instance, in the organization, or the board members that maybe also log into the financial systems to see what's going on, or have reports prepared for them and stored in a particular location. So IT controls are very important, and they protect the company and help improve the effective financial controls environment. Welcome. One of the challenges we find with financial controls is that sometimes they need updating. They need updating regularly, frequently. We've spoken about reviews, we've spoken about certain things happening, budgeting. Budgeting changes periodically depending on how the company is performing against the objectives, how the markets are, how the economy is going, what kinds of what kind of focus the company wants to divert or allocate resources to. So all those things, as they change, the controls around the finances, around the financial reporting, controls around what is being measured also need to keep up with those. And sometimes these changes are brought about by many, many different things, some of which we'll look at. We'll look at a couple of them here, a few of them in this particular segment. So timely updating of financial controls is crucial to ensure that an organization's financial activities are conducted in a responsible and transparent manner. So we're not using financial controls that were designed for another period of time when the organization was focused on something else. A good example would be that many organizations have transitioned to becoming more technologically dependent over the last 10, 20 years, over the last decade, you'd say. If an organization that was used to being more physical product dependent had financial controls that was heavily leaning towards that, well, over the last 10 years, those same organizations have moved over to become more technologically dependent. For instance, clothes manufacturers or people that sell physical products who are now creating online products, who are creating online stores and have heavy online presence on all the general stores that we know about, general e-commerce platforms that we know about. There's a need to also, because that's a strategic directional change by management, there has to be, or they have to put in place financial controls that mirror that reflect the direction the business is going in. Otherwise, the financial controls will be inadequate on one side of the business and probably not serve the older bit of the business that they adequately served in the past. Here are some details on how organizations can ensure timely updating of their financial controls. Regular reviews. Regular reviews of financial controls are essential to ensure that they remain effective and up to date, like the example I've just given. Organizations should conduct periodic reviews of their financial control policies, procedures, and systems to identify any weaknesses or gaps that need to be addressed. Reviews should also be conducted by an independent party or internal auditors to ensure objectivity and thoroughness. And I can't stress this enough. The regular reviews where more than one person looks at a particular item or looks at a particular piece of work and also assess whether all the things they're doing, and other people also come together to within an organization like auditors or management, to understand whether the controls they have in place, financial controls they have in place, adequately serve the organization and the direction which the organization is going, is something that determines whether there are exposures or gaps or weaknesses that can actually create problems for the organizations in the long run. In the past, we used to get bank statements by letter on paper form, but most of these things are done online now. And are those controls adequate and effective that you have in your current system? Are they serving your current objectives? Welcome back. We continue looking at updating financial controls and the instigators or things that should make us look at updating them, and potentially how we should approach them. So changes in regulation is another one. There are times when there are changes in regulation in terms of the example that will apply to most businesses around privacy data management. You don't want to get fines, or you don't want to get into a position where you're infringing on those rules. So for instance, if you're a company, you've been told that you need to do some kind of background review or checks on the customers you're dealing with to ensure there's no money laundering or there are no other nefarious ways of those businesses earning money and then coming to coming to buy products from you, coming to patronize your business to as part of their scheme, then you need to put in place a process where you can actually carry out some reviews or checks on who you're dealing with to ensure that is the case. Otherwise, you might get involved in something inadvertently that wasn't what you set out to do. Obviously, as a business, because again, it does not meet management's objective. It does not help you protect your entity or protect your business. So changes in regulation are very key, especially in certain areas in the medical field, in the banking sector, in pharmaceuticals, in many other areas. So changes in regulations and laws can impact financial controls significantly. Organizations should stay abreast of changes in regulations that impact their financial activities and update their financial controls, policies, and procedures accordingly. Failure to do so can result in non-compliance and legal penalties, and also reputational damage. There's a lot of stories about companies we hear about almost regularly, where we hear they've infringed on certain things, or they didn't carry out certain activities that could have helped them because changes in regulations took place. For example, new laws or regulations might require additional documentation, like the example I gave earlier on, or reporting or disclosure requirements. Organizations should ensure that their financial control policies and procedures are updated to reflect any new regulatory requirements. If you're in the insurance industry, if you're in the banking industry, if you're in many of these areas, regulations change very often or very frequently. It is beholden on the organization to put a process in place where those are caught and the financial controls are assessed for adequacy and improved where required. So changes in regulation are very big for your organization. Welcome. Advances in technology or technological advances is one thing that is constantly all around us, and our financial controls must go along with that, must keep up to pace with that. Technology is constantly evolving, and organizations must keep pace with technological advances to ensure the effectiveness of their financial controls. As new software and hardware solutions become available that are meant to make life and work easier, organizations should evaluate them for potential integration into their financial systems. But we all need to be mindful as we evaluate these things. We also have to evaluate the potential of these things going wrong, or someone getting access to it, someone that is unauthorized hacking in, or being able to access the data, or sometimes even physically being present in the organization and supplying information to other people, especially financial data. There are all sorts of cases we hear about, insider trading and people having information that they shouldn't. Some of those things are brought about by people who are within an organization and have access to maybe some level of technology within the organization that they shouldn't, and they see maybe board minutes or management decisions or conversations that they should not be privy to and that they're not authorized to be viewing. So which then impacts the organization, impacts the share price, impacts the reputation, and potential fines are levied by various regulators. This includes incorporating data analytics tools to help detect anomalies and strengthen fraud prevention, especially where maybe all your systems or majority of your systems are carried out online. Data analytics tools can identify patterns in financial data, flagging transactions that fall outside the expected range. These transactions can then be reviewed to ensure that they are not due to nefarious activities, fraud, or errors, or things that are not in line with management's objectives for the organization. These tools can also be used to identify potential risks and opportunities for improvement in financial controls. These days, you can get tools that actually show you gaps in your processes, gaps in your reporting, gaps in your financial control, financial control framework that would facilitate you plugging those gaps, closing the loopholes where there are any, and keeping compliant. So technology is great and it's good. We just need to be mindful that we keep updating our financial controls around technology, as we've discussed previously as well in various segments. But it is one of the reasons, it's one of the triggers or stimulators for updating financial controls. Updating financial controls, training, and communication. Effective financial controls require the participation and cooperation of all employees. Organizations should provide regular training and communication to employees about the importance of financial controls and their roles and responsibilities in maintaining them, in maintaining an environment where financial controls are important, where controls generally are important. Maintain an environment where you put a process in place and people follow them and review those processes for improvement all the time. Review and adhere to the various policies and guidelines that are provided that facilitate a robust financial controls environment. For instance, double review, twice reviewing certain sensitive information twice, making sure you don't give your password to someone else to look at or to use to log into something, and because you don't have control or you don't know what they might be able to do. But it's understandable that some people might not know. So those things need to be communicated over and over again. They need to be reinforced. That knowledge needs to be passed on. That knowledge needs to be written down as a process and a procedure. And members of colleagues and members of staff you must discuss the importance of these things with them, and you must listen to their feedback as well and hear what they have to say and their thoughts around it, and communicate it constantly. You can provide it by way of training, by doing regular quarterly training. There's some industries that you have to do certain training around anti-money laundering, training around compliance-related issues, training around how to keep abreast with your certification if you're a regulated person. Many industries require continuous professional development, CPDs. That's why those are in place, partly to enable you keep comply with the standards required for that role. And especially in finance and accounting, you will come across a lot of financial control related type trainings. This includes providing regular updates on changes to policies and procedures and reinforcing the organization's commitment to ethical and transparent financial practices. Employees should be aware of the potential risks of financial fraud and the role they play in preventing and detecting it. So it cannot be overemphasized how people need to know and understand what the importance of financial controls are to the continuity of the business, to the continuity and the improvement and growth of the organization, for confidence by stakeholders in the organization. Welcome. So I want us to look at common challenges and mitigation to these challenges for financial control, or for instituted financial controls in your organization. A lot of the common challenges relate to things like cost and complexity, and we'll look at a few other examples. Cost. One of the most significant challenges of financial controls is the cost of it, of implementing and maintaining effective financial controls can be expensive, especially for small businesses with limited resources. The cost of technology, the cost of training and personnel to implement and maintain controls can be a significant challenge. However, if you run a small business, curate appropriate solutions, and this is the mitigation, to the size of your organization, to the size of the thing to the size of the amount of revenue you're making, to the size of the number of staff you have, because we talk about segregation of duties and so on, but if there are only 2 or 3 people in an organization, it is understood, or it is expected, that there will be some overlaps in these functions. However, at the same time, the size of the organization and the number of transactions you have to go through might not be as large as might require that, even though there are overlaps. So curate appropriate solutions alongside the size of the organization required. Then complexity. Complexity is another challenge that many businesses have. Financial controls can be complex and difficult to understand, especially for non-financial staff. This can lead to confusion, can lead to errors and non-compliance, which can undermine the effectiveness of the control environment overall. Organizations need to ensure that their financial controls are designed in a way that is simple and easy to understand. Simplify your processes to reduce complexity, but support the effective financial control environment. So there is that need for that to happen, where You have to tailor again, similar to cost, the simplicity of your environment and the number of people you have, the size of your organization and transactions and the volume of transactions you're doing. You need to look at simplifying that to reduce the complexity and begin to address financial controls around that, especially when you're small or when you're not a big organization and you're growing, because that then gives some sustainability or ability to grow within that industry in a very short period, and simplifying your processes helps get that done. See you in the next segment. Welcome. I want to look at common challenges that businesses face that will that will pose a challenge or pose a problem or some kind of issue, and how to mitigate them. We looked at some in the previous segment, and I want us to continue looking at some of those things and how to mitigate them. Resistance to change. So employees may resist the implementation of financial controls, especially if they perceive the controls as restrictive or burdensome. This can lead to non-compliance or lack of commitment to maintaining the control environment. Organizations need to ensure that their employees are properly trained on the importance of financial controls and how they benefit the organization. This will help create an environment where people appreciate what those controls do for the organization, what it does for them personally, what it does for the meeting the organization's objectives and goals. Again, it's about creating an environment, which is the mitigation now, create an environment where everyone understands the importance of controls generally, wherever you are, whether you are someone at the front desk or someone at the top of the business, that we all appreciate the importance of controls and how they keep the business safe, how they help the business continue going in the direction it wants to go in. Another challenge is limited resources. Small businesses may not have the resources to implement or maintain a robust control environment. This can lead to inadequate controls or increased risks and potential fraud or errors. Organizations need to ensure that their financial controls are scalable and can be adjusted based on their available resources. Some financial controls can be implemented through third party, and this is a mitigation now, through third party and technology platforms. For example, there are some banking services that offer you additional add-on services that, for instance, notification if someone else logs into your bank account, or if a certain amount above it comes in, it's swept into another wallet or another account within your bank account. Or where you want to reduce your exposure to taxation, they tell you you want a percentage of all the funds coming into a particular bank account swept into a savings account that is dedicated to paying taxes or paying payroll or paying staff and so on, paying suppliers, things of that nature. Those are the kind of things that you can implement as a small business. Look into technology, look into some ways of outsourcing it, maybe people that do fractional related type services, and that will help you mitigate those risks even though there are limited resources. Welcome. Let's look at some other challenges that an organization might face in trying to implement and maintain an effective financial control environment. System integration. Financial controls may require integration with other systems such as enterprise resource planning systems, ERPs, there's so many of them around now, or accounting software. This can present challenges. The process of integrating can present challenges, and therefore, especially if the systems are not compatible and require significant customization. In that process, sometimes you have where controls need to change, need to be updated, or controls actually go away because the new systems are providing maybe one layer, a particular additional layer of control that has been settled on or reviewed or agreed upon by management before picking that. So that can present a challenge in itself, and that needs to be reviewed, understood, and ensure that the effective financial control environment is not compromised. Organizations need to ensure that their financial controls are integrated with their existing systems, and that any necessary customizations are made to ensure that that environment is maintained. and not transfer it to, for instance, manual financial control tasks or manual financial control processes. Basically, systems integration needs to be looked at as a whole to ensure that you don't compromise or you don't reduce the level of effectiveness of your financial control environment. Another challenge is also human error, and the way to look at it is sometimes people make mistakes because we're humans, and that's just part of it. Sometimes people overlook things they shouldn't. Sometimes people approve things they should not have. They should have that, or that they haven't performed the right checks to ensure that these things should have gone through. And even with the effective financial controls in place, human errors can occur. This can be due to lack of training, can be due to fatigue, people are just tired or overworked, or simply overlooking a control step. Human error can undermine the effectiveness of financial controls and lead to increased risk. The way to mitigate, organizations need to ensure that their employees are properly trained on the importance of financial controls and embedded in their effective implementation into normal business as usual processes, so normal daily processes. Reviews also help. Reviews are critical to the mitigation of these human errors occurring because someone else might pick it up and point it out, and it can be caught or captured before it actually gets out of hand or gets to a point where it compromises and affect the effective financial control environment. Welcome. Compliance with regulations is a challenge for many businesses, small and large, because regulations sometimes change frequently, or they just don't know. They're not aware of these regulations and they fall foul of them, and the exposure to paying fines and risk actually being prosecuted or facing legal action or reputational damage. Compliance with regulatory requirements can be a significant challenge for organizations, especially in highly regulated industries such as banking and healthcare and insurance and so on. Failure to comply with regulations can result in fines, reputational damage, and legal consequences. Organizations need to ensure that their financial controls are designed, and that is a mitigating factor, designed to comply with relevant regulations, and that they are regularly reviewed and updated to ensure ongoing compliance. And one way of doing that is getting updates from regulatory authorities, from bodies that look after these things, industry bodies that actually send out updates on changes that are going on frequently in your industry that help you keep abreast of what changes you need to make, and subsequent to making those changes you then need to update the financial controls around that. For example, if there's a new return or report that is required by your particular industry or by the authorities, for instance the tax authorities, you need to have an appreciation of what that return is, how it impacts your company within that industry, and maybe attend some information sessions. There's so much information available out there. Or get consultants if you're large enough and you can afford consultants to actually carry out a review on your system or help you identify or narrow down the areas which you need to focus on so you can be within compliance, so you can mitigate that risk and possibly put in place a calendar of when that return is required and what is required within that return. In summary, financial controls can present some challenges, like some of the things we've seen, including cost, complexity, resistance to change, limited resources, system integration, human error, and compliance with regulations. Organizations need to carefully consider these challenges and develop strategies to overcome them, some of which we have mentioned to so they can maintain an effective control environment. This again it brings confidence into the business, helps the management achieve their aims and objectives, and reliance on the financial reports and financial transaction documentation that we can see and protect the organization for a sustainable and prosperous future. Welcome. In conclusion, financial controls provide the basis, a reliable, sustainable, growth based basis that businesses can operate. It gives you the confidence, whoever you are in the business, whether you're a staff member or an investor or you're part of management or decision makers, of the health of the organization, of the financial health and status of the organization. It helps you know that you're in a good place, so it helps you know the position of the organization, which you can rely on, and then take decisions based on that. So effective and good financial control environments, effective financial control systems or frameworks permit the organization to make certain decisions because they are certain of their performance, of where they are as an organization. And some of the measures we've discussed in some cases require repetition, regular repetition. Then they will apply in various elements and various aspects of the business, and they will be replicated in those elements and aspects of the business to ensure that the outcomes you're getting, the financial numbers you're looking at, the financial management of the organization as a whole is geared towards the objectives of management, it's geared towards the goals set out by management. The benefits of financial controls include increased transparency and accountability, reduced financial risks, enhanced decision making, and improved operational efficiency. In conclusion, the financial controls are critical to the financial health and success of any organization, and they should be given due importance and attention. So thank you for taking this course, and look forward to seeing you on another one.